Live with three, two, one. We are live.
Good evening, friends, ladies and gentlemen, esteemed participants. It's my pleasure to welcome you to another edition of Finwise, through which we endeavor to keep you informed on what's happening in the markets. And tough as it might be, try to demystify a little bit of what's happening in the markets. Uh, we hope this in turn will help you make informed decisions when it comes to your own investments. And you take something away from the information that our speaker will give you today. Allow me to introduce our head of research, Dharmesh Kant, who's a very well-known name when it comes to the equity research functions. He has spearheaded the equity research function in marquee organizations like Motilal Oswal, Edelweiss, Angel, and he understands the market dynamics, the investment strategies, corporate earnings, and uh, quoting them, he's earned a stellar reputation. Whether you're a seasoned investor or an aspiring financial professional or somebody who's just wants to understand what's in the market, I'm sure that today's discussion will leave something with each of you. Uh, Dharmesh is, by that way, is quite a familiar face as he's been featured as an expert on CNBC, ET, Z Business, etc. Uh, Please join me in extending a warm welcome to my friend Dharmesh. Dharmesh, we look forward to hearing from you.
Yeah, thank you so much, Sridhar. Good evening, all, and thanks for taking time out for this session of ours. So it's not a session; it's more of a interactive talk which we would be having, and I will be walking you through how the present scenario is, and it's more about to do with the market outlook, both international market outlook, the global front, as well as what's happening on the domestic front of the market. So first thing first, I mean, the first thing which comes to the mind and which is plaguing and playing in all our minds is the geopolitical tension which has happened in the Middle East, particularly between Israel and Palestine. So the world has seen many seasons since 2020. First it was COVID, then in 2022 Russia-Ukraine war happened. And as we were all recovering from all this vagaries of the outcomes which were there, and now you have this a war which has erupted between Israel and Palestine, with all the makings of culminating into a World War III. So that is the resonance of the sound which has been made by most of the observers or the countries which are sitting on a sideline and preparing to jump into it. But my own sense is that these are rhetorics, these are noises which are being created not to have a war in place. So it will again die down the same way the Russia-Ukraine thing has happened. And slowly, with the passage of time, this activity of Israel may continue in the Gaza Strip, but it will not culminate into a full-blown war. So this is the safest assumption which one can take. As of the good part about this entire episode is, I see there are two aspects to any geopolitical development or tension. One is the human aspect, which sadly has been really bad, and we all pray for the souls which we lost in this crisis. And the other is the economic aspect. So on the economic front, nothing has happened as of now which would derail the existing economy which is going on across the world. So there has not been any supply bottleneck as of now, and neither there has been any demand outlook change from the world economic participants as such. So going by the, if you look at the Baltic Dry Index, which takes into consideration the shipments which are made between countries, so that's already trending at a quite higher levels, and it's been increasing every month. So trade has in fact increased on between countries in the last 6 months, and it has been on a higher upward trajectory. So far it's just that sentimental and tentative trading plays are happening. Some opportunistic trading bets are playing out for The case in point being oil prices. So we have seen a spike up, then a big correction, then again Friday onwards some spike up has happened. So these things will keep on happening depending upon the vested interest which are there, and they want to play this volatility out as well to the best of their advantage. So we will continue to see this spike up and spike down in oil prices. But the point here is that uh, OPEC countries or the GCC countries have decided to cut down on the oil production. And this cut down in production is more to do with the oil demand, which is coming from the globe. It's not to do with some scarcity kind of a scenario creation. Because since they knew that oil demand is coming down and this announcement will help some price uptake, and that is precisely what played for them. If you look at, Europe, it's mostly they have turned electric. So even, vehicular movement, all the vehicles are now, most parts of the Europe, they are electric. Even the industries like steel. So it's more of electric arc furnace rather than blast furnaces. So the entire transition has happened in Europe. So the demand for crude oil has to go down, and 1% kind of a decline in the commodity demand is good enough to trigger a 5 to 10% kind of a price correction. So that is what we have been witnessing. US is gradually moving towards clean energy. So that again would be, not suited for oil producing countries, and Asia is on this course, including our country, India. So one has to just keep aside such activities or noises happening. But yes, having said that, the caveat here is in case this blows up in a major way, then definitely there would be supply bottlenecks coming in because Iran, Iraq, and Syria, Lebanon all would be participating. So the commodity flow or the finished goods flow or the shipments from Asia to Europe and Middle East and African countries will come under a problem. So that's the scenario. But as of now, I think that's 5 to 7% kind of a probability that this may happen. Because if it has to happen, you must, by this time, global market would have reacted more severely and more aggressive selling would have been there, which has not happened. In fact, last week, if we look at it, US was more of a flat kind of a market on a week-on-week basis. It was Europe which was down around 1% kind of a correction was there. In Asia, it was largely up 2 to 4%. In fact, in Asia, India was the underperformer in the week gone by. And the case in point here is that Asia will largely remain insulated from this disturbance happening in the west side of the African countries, I mean the Arabian countries, which is there. So it won't impact Asian trading community and the countries out there. So some flows came into Asian in the markets and the buying was seen. Other part, apart from this geopolitical tension, what other aspect which just before that everybody was concerned about was the US market. And there the talk about further interest rate hike was what is being the fulcrum of all this volatility happening out there. So one trajectory is very clear. Even if there is a interest rate hike, it would be one more in the month of November, and that should be the end of it. My own sense is that it will not happen even in the month of November as well, because commodity prices have cooled off. Inflation has come down to 3.7% in the US, and it has been holding around those levels. Their Fed fund target rate is 2%. But as long as inflation doesn't look like going up, Fed won't be taking any further interest rate hike out there. The underlying economic undercurrent remains strong. If you look at unemployment data, it's still at 3.8%. Wages have been seen some sequential growth on the hourly basis, and the other parameters like inventory levels or the manufacturing output of capacity utilization is all near 77, 78% as far as the factory capacity utilization in US is concerned, which is a very healthy rate of capitalization going out there. So to sum it up, I don't think US is there for any root shock as far as economic I mean, recession or talk about that was there a few months back, which has totally evaporated. Now people are talking about more of a decelerating economy, which we have seen from 2.4% to 2.1% in quarter two was there GDP growth, and it is likely to bottom out near those levels. So people are not more talking about that this deceleration may get more prolonged as long as interest rate remains at a higher level. So that is one aspect of the US market. Second aspect is this higher rates isn't going to impact financial sector in such a way that there can be a collapse or a crisis happening out there, which again looks very unlikely because there are two aspects to it. One is in US, the normal norm is when people borrow, they borrow for a long term on a fixed rate basis. So whatever 1 year back, whatever loans were taken by their households or the corporates was on a fixed rate basis. So they are anyways not affected by any interest rate hike. When this hike started happening, this word was very clear that this is not going to stop immediately. This interest rate hikes are likely to continue. So the people who would be planning their purchases, I mean, be it cars or houses and other stuff, they would have definitely delayed their purchases because had they gone ahead, some pain in the asset quality side should have been visible, which is not there. Even JP Morgan Chase reported the number yesterday. It was a very good set of numbers. No problem out there. Basel III norms have been implemented out there. Because of that adjustment, some NPA provisioning may happen in Q3 and Q4, but that should be the end of it. The only worry part in US is the corporate lending part on the property segment. So the offices which were newly rented because of the surging US economy out there, those are the places and those are the concern area in US because the finance for renting these commercial places have gone up. So what companies are now started doing is they have been started vacating those commercial places, and work from home kind of a culture is now again being put into place in the US just to save on the rental cost. Because of that, the real estate developers who have developed this commercial properties to be let out to office are in a spot. So that is one segment which can actually lead to some problem on the financial sector out there on the asset quality side. Secondly, what is happening is because of a transition to AI and generative AI and machine, which is again a machine learning based kind of entire system. So people are postponing their discretionary spend as well, apart from the non-discretionary spend. So what people have been doing is they are holding on to the discretionary spend to have a better option available in future, better software which will be cost effective and they would be add to their profitability and EPS accretive kind of a software. So discretionary spend has been put on hold. As far as non-discretionary spend was there, wherever the migration has happened to the new software in the AI model, so you don't need the old software. So non-discretionary spend to that extent was not there for Indian IT companies, which are primarily SaaS provider, a software as a service provider. So they don't develop products, so they don't develop, this AI, artificial intelligence software. So now a lot of tie-up has happened out there. And because of that, these companies will start getting orders maybe 1 or 1.5 year later. So that impacted the Indian companies, but we should not go with our perception that there's a slowdown in the financial sector in the US. Financial sector in the US is giving new orders to companies where they are getting the software which they need, which Indian companies was not having at present. So that's the reason why you see a disconnect between technology stocks in US and technology stock in India. So all the technology stocks in US, the Nasdaq is around up 28% year till date. And the reason being the new companies, Accenture and others of that same bracket of the world have come out with the software which is very much cost effective on the employee side, as well as they are embedded with artificial intelligence and generative AI, which is being put to use for a better business out there. So their financial system is working well, the entire sector is doing well. What is happening, the benefit which should have been accrued to Indian companies is not there. So even that point is mitigated. Europe has been a worry for last 10 years as far as the growth is concerned, and it's likely to be the same scenario going forward. So Europe is more or less largely negated in the global context of things to drive the economic growth. So people look to US, China, and India. China was a concern, but last week onwards, they have started rolling out stimulus packages, and these were anticipated by the world market for last 2, 3 months. But it's started rolling out now. And I mean, my observation of China is when they roll out a policy, they stick to that and they keep on adding further stimulus to that. And that is the need of the hour in China. So this will help the metal market and the economic growth picking up globally, the consumption, because if China becomes a spender, it does move the economy. They are the second largest GDP anyways in the world at $19 trillion per annum. So to sum up the global outlook, the only caveat to my mind as of now, which can play a derailing kind of a situation, is a condition where Israel goes into this situation gets aggravated into a World War III kind of a crisis. As long as it is localized, no problem out there. And the sense is that it's likely to remain localized, and the market in a week's time should be market is usual. Second point is what will happen about the Fed. So there, I mean, the jury is divided, the commentaries are divided, but we do think that at best November can be one more rate hike, and then this is done with, and we are in for a at least stable interest rate, if not a declining trajectory immediately. So fundamentally, things seems to be settled. US market is going to consolidate at our current levels with some profit taking happening out there. Europe can see a good profit taking happening out there for the balance of the year. However, our market stands totally, in a different platform, a different trajectory. So coming to now Indian market. It's the sweetest spot in the world right now. Every commentator, every foreign brokerage house, Indian brokerage house report is saying the same. And this is not mere for the sake of saying, this is actually what is happening out there in the real economy. Look at the type of tax collection which has happened over the last 6, 7 months. It has been the best in the history of India. GST collection is averaging around 1.65 lakh crores per month, which was when it was, I mean, 3 years back, it was not even 90,000 crores of GST collection in a month. What this GST collection has done is now tax authorities have all the artificial intelligence and the software and tools in place. Through this GST, they have also been targeting now direct tax collection for getting the income tax payment from individuals who are the owners of these businesses as well, the people who are paying the GST. And that has helped, to get a net direct tax collection also far higher. So you can see in the slide, it's like for the last month, I mean, till October 3rd or 5th, it has gone to 9.57 trillion. That is 9,57,000 crore rupees of direct tax collection, which is 22% higher. So tax collection is happening at a growth of around 15-16% for this 6 months, where the government has earlier guided in the budget of 10%. So 5% kind of a overshoot is already being there. And Q3 and Q4 are the quarters where the maximum tax collection happens. So if this trend is likely to continue, it's very likely that Indian government will end up with 10 to 15% kind of a surplus net tax collection, inclusive of both direct and indirect, than what they have given in the budget. And that gives them the elbow room to continue with the infra spending and take care of any adverse movement in the crude oil prices, even if it happens. So even when the crude went up in the recent time till 97, 98, when Brent went up, there was no increase in the fuel prices in India. So that question, that the shock they have absorbed, and they were sitting on around 5 lakh crores of extra surplus because the period, if you calculate when the crude went up in the Russia-Ukraine phase was 6 to 7 months, and then the cool-off period was more than a year, where India did not reduce the petrol and diesel prices. So refiners were sitting with that surplus, which they have absorbed this recent increase in crude prices, and that is the reason why there was no uptick in the inflation. Because if the price has not gone up, international market may have gone up, but for India and the consumption side, it has not gone up. So you can see retail inflation has dropped to 5% in the month of September, and it was the lowest in the last 3 months. And this is put into context with the RBI. I mean, suddenly they have come out with a guideline when they said that they are targeting 4% inflation rate. Earlier, it was always a band between 4 to 6, but since they have said 4%, and it's racing towards that. Monsoon was, I mean, slightly weak and not evenly distributed as far as the days and months are concerned, but it reached its marks. Showing was a little less as far as pulses is concerned, but India has a sufficient reserves to take care of any lesser acreage or output coming from the pulses segment. So government has already started putting mechanism in place. If you see the rice, basmati rice export has been banned, and all those measures are already in place so that there is no untoward food inflation kind of a volatility happening out there as far as grains, cereals, and pulses are concerned. At best, food inflation will come as from vegetable, poultry, and milk prices. So that is beyond the control of the government. If any shoot up is there, we can still see that happening into the inflation side. But core, I mean WPI inflation or the core inflation is already being taken care of. Industrial growth was at a 14-month high, around 10.3%, and this has been increasing. And this is backed by you can see that happening in the mining sector growth. You can see that happening in the power consumption growth. So this segment has been doing very pretty well, and this has been reflected in the GST collection or the e-way bills, which is being collected out there. So again, a very good indication of the health of the economy. And unemployment rate in India was fell to around 3.2%, and it was again a 6-year low. So fundamentally speaking, on the macro point, there are all tick boxes, all the boxes are ticked green. So there is no concern on the macros. Globally, US, though it has been slowing down, but still there is no concern on the economic macros out there. Europe was a trouble spot. It will remain a trouble spot. China has started taking corrective measures, so it will again go up to adapt to the world economy. Israel thing is likely to die down in 4 or 5 days. If it does that, then we are setting in for a good earnings season. Now coming back to the micros, and earnings season has already kicked off. We have seen the IT space, information technology space came out with I mean, disappointing set of numbers. So the numbers disappointment was being expected out there. But what was more disappointing was the downward revision of the guidance. So it started with Accenture, which is not an Indian company, but then TCS number and then Infosys when guidance when it was revised downward, even SCL, their tech numbers were revised for the guidance part, they revised it downward. But still here, the hope trade is playing out even in the IT space. And the hope is that the worst is already in the price, and now and not only the price, the worst is also now priced in the guidance which all these companies management have been giving. So from here, from Q3 onwards, things are likely to improve on the guidance front. And slowly, when these all AI tie-ups, which all these Indian companies have done with their American counterparts, they will start flowing in. And the first sign of green shoot out there, maybe in the fourth quarter or the first quarter FY25, then the numbers and the estimates will get re-rated with the new services which the Indian IT companies will be providing to their American or European counterparts, and that will take care of it. So as of now, strategically, it looks, lucrative to have a buy bet on the Indian IT companies, because eventually they are definitely going to get business out there. And that is the reason why We have not seen continuity of the selling, which was there for a couple of days post the announcement of results. Here also, the segment remains very divided. I mean, the companies which are into engineering, research, and development, those are the companies which are likely to do well, like Larsen and Tubro Technologies Limited, or for Meta Scient or Scient DLM. These are the companies which will do far better than the companies which are into vanilla software services provider. So one has to be mindful of that. But there are still, too many ifs and buts surrounding the IT space. As a trade, it's been playing out on the buy side, but whether it will become a wealth creator or a good investment buy over a 2 to 3 year time horizon, jury is still divided. We would wait for some kind of a semblance coming in where we see that actually a new era for Indian IT companies has begun. And see, I have a very clear logic. If fundamentally something looks to me from going to say from 100 to 300 or even 200, I would mind buying it at 130 or 125 kind of a levels. Let the 10-20% move happens, which confirms our belief in faith and the market participation. Rather than getting it at 100 and stuck or selling it at 40 rupees or 20 rupees kind of a scene. So that is not a strategy. A strategy should always be let some money on the table, let other people enjoy that ride for 10-15%. But once you are fully sure about your analysis and conviction and it's reflective in the price, then there's no problem jumping into it because still 70 rupees is there on the table for you to take away. So IT sector as of now is more of a wait and watch from the sidelines from the investment point of view. From trading perspective, technicals can always play out. The best sector which is going to be, which have started in fact reporting their earnings and which are likely to report good set of numbers is the financial space. So there we see, I mean, these are the private sector banks which have reported their advances growth. On an average, if on a Y-on-Y basis, around 25 to 26% kind of an AUM growth has been seen. The best part has been even on the quarterly basis, advances have grown by 4 to 5%, which is phenomenal to any analysis. And this kind of a growth has come on a backdrop of when there was worries about monsoons. Interest rates have been going up. So on a rising interest rate scenario, if this is the kind of a growth, just imagine a bit of a cool off in interest rate just to bring it on parity with the world interest rate coming down. What kind of a growth these companies can likely to see? So be it private sector banks or a public sector bank or even NBFC space, same kind of a growth in the advances we're seeing across the board. This morning, today we have two results coming out, and the Bank of Maharashtra and Federal Bank have reported their earnings today, and the numbers were again phenomenal because if you look at the names of Bank of Maharashtra, it has improved on a quarter-on-quarter basis as well. And the net interest income growth was around uh, almost 28-29% on a Y-on-Y basis and 4% on a quarter-on-quarter basis. For Federal Bank, the net interest income growth was around 17%. And the best part is asset quality has remained impeccable. There has been an improvement in asset qualities. The management commentaries suggested that credit cost has come down. It's likely to come down. The only worry part about the financial sector space has been the NIM, that is the net interest margin in Q3 and Q4. There are a very high chance that it will be a 20 to 30 basis point kind of a hit out there. Reason being, interest rate has become stable at the higher level. So when they have been lending to the customers, they have been lending at a higher rate, but the deposit rates have not gone up. That is the cost of fund or the cost of asset holding is now gradually starting to go up. So there was a 20-30 basis point kind of a cushion out there because of a time lag by which the deposit rates are likely to go up, which is now started to happen. So Q3 and Q4, there would be some NIM compression coming into play. However, if NII, that is the net interest income, continues to grow at the same scorching pace, then this NIM compression or the margin compression can easily be taken care of. On the net basis, the profitability basis, you will again see a 20-25% kind of a growth on an aggregate level, followed by a strong asset quality. That is where the entire scene is. So this entire space is buzzing. My own sense is that public sector banks are a better buy at current juncture, only because it's first is that the private sector banks always used to have a higher delta as far as advances growth was concerned, around 15 to 20% if their advances was growing. Public sector bank was on a high single digit, around 7 to 10%. Now what has started happening, if you look at the PNB numbers or the Jammu and Kashmir Bank, they all have reported advances growth in excess of 15%. So like you can see the table out there. And now they are catching up with the private sector banks. Asset quality is already improved and catching up with the private sector banks. So when business is catching up with the private sector space, then valuation multiples has to be re-rated, and that is precisely what we have been seeing. And most of the public sector banks are still trading below their price to book value, that is 1 times the book value. So even if it trades at the book value of 1.2 or 1.3 times the book value, around 40 to 50% kind of an upside can be expected in individual stocks. I will not be taking the name of the banks, but the top three, four public sector banks are looking very attractive. Leaving aside SBI, because SBI is already trading at say 1.7 times price to book, and Bank of Maharashtra is around 2 times price to book. If you look at private sector banks, they all trades at around 2 to 2.5 times price to book. So even 50% kind of a catch up will give you a 50% kind of a stock based correction. So a nice piece to be. And in the NBFC space, I think there are plenty of good opportunities. So if you are not even looking at the best of the lot, like Bajaj Finance, so the others in the lineup also looks very attractive, and they have a more juice in to play out as compared to Bajaj Finance. So those are the stocks where one can look at from a good positional buy or investment buy. Now coming to another sector, FMCG. So FMCG sector this quarter won't be doing good. Most of the companies have, I mean, the companies which have reported like Marico or Godrej are expecting mid-single digit to high single digit kind of a growth on the volume front. Price hikes was not, they have not taken any price hikes. So blended realization won't improve much. At the same time, the good part of with these companies were that input prices have remained fairly stable. So margins will remain where they were. There won't be any negative surprise on the margin count. But selling was a problem with them because most of the dealers complained that they have been making smaller sachets and dumping the products to them. And there was storage problem with the end seller, that is B2C, when because the offtake was not great enough, and which has again been reflected on the volume commentary which they have given. But from here on, going into the festive season with the monsoons almost near normal, and usually before elections, some kind of a subsidy, some kind of a money into circulation does come into rural and semi-urban areas. And that would definitely boost the volume growth of all these companies. So there you can expect a good run up. On the number front, as far as Q3 and Q4 numbers are concerned, Q2 would be a muted kind of a number. Nothing much to expect out in Q2. But in Q3 and Q4, you can see a build up. And the quality part is that the stock prices of most of these companies are around 10 to 12% lower than the recent highs. I mean, this year high. So there is plenty of margin of safety and a catch-up trade to play out there. So Britannia's and Nestle's of the world can be a good play depending upon how the situation pans out, which I think should pan out in a good way. This is a more of a consumer durable segment is there, which is more of a diversified kind of play. If you look at the company wise, so jewelers have been doing pretty well. I mean, stock prices, all the jewelers are running up like crazy. Be it PC jewelers or Kalyan, and things are happening out there. Though valuations are now sky high. I mean, if you look at from the valuation perspective, nothing is justifiable. But the momentum play is happening out there. Titan reported their business division growth of almost 19% was a revenue growth for year-on-year basis. And there was a robust domestic growth of 20% coming into play. Same has been the case with Kalyan Jewelers when they reported the numbers. So jewelry segment has been buzzing around and has been doing good. And we are already into the festive season, and then the marriage season also is there. So some momentum, traction, on anticipation of who can do much better when they report their earnings. So such kind of a trading place will be there. But the one trade is very clear. These are buy trades as of now. So any correction which is being induced in these stocks because of market, one should be looking to buy them. Avenue Supermarts, that is DMart, reported their numbers. Volume growth was 70-80% in line, but the gross margin was a mess. It has been declining quite rapidly because of the product changes. Because earlier when they came up, it was apparel and other household consumables were there, which was gaining traction. But I think now it's more of a specialized and localized kind of sales which is happening. If somebody is to buy clothes, they will not buy from DMart, but Westlife has better options out there. So there you can get the better stuff at a lower cost. So things like that has happened. So it's more focused on now a grocery kind of a store. And that is the reason why we have seen decline in the gross margin. Here, the point to be noted out here is that still trading at more than 100 PE multiple, whereas the top line growth at best can be 20-25%, and with a decelerating PAT growth or the operating profit growth. So that problem is likely to be there. So it's better to avoid than to, jump into it. Same is the case with the VMart retail. So in this consumer durable space, I think only jewelry is one segment where still, you can expect traction and fireworks happening. Other places, even companies like Voltas and all, that is electrical consumables, you won't find a great traction happening out there. Metals, a very difficult sector to negotiate. As far as playing out is concerned, it's always cyclical in nature, and there are too many vectors which influence this sector. It can be China, it can be global environment, it can be supply bottleneck, it can be higher demand or a demand slowdown, depending. And these are basically cyclical in nature and a long gestation kind of a play. So if any infra spending is happening, different quantity of material is required at different points of time in this entire construction activity. And because of that, a lot of uncertainties are there. Then there is a currency play because most of the metals which are produced overseas are sold in dollar terms. So if dollar gets appreciated, then as a parity trade, the prices come down. But nonetheless, looking inward looking economy, if you look at the domestic economy, there the things are happening. The construction infra space is doing pretty well, and there we have seen NMDC reporting consistent sequential production growth. I mean, the production was up by 10%, sales was up 7% for Q2 when you compare that with Q2 of same year, same time last year. Coal India production has been going up very fast, and the prices have also moved up. But my only point here regarding Coal India is that if you have already taken it at lower levels, enjoy the ride, keep trailing your stop losses, because the main consumption of coal goes into the power segment. So, and if we will come to the power slide, there you will notice why I am saying so. But most of the additional new power capacities which are coming up is more than 90% is coming up into the renewable segment. So thermal power plant is now a thing of the past. It's not going to be the future. So this coal demand is likely to hit some bottleneck going out there or the ceiling. So this is just a trade which has played out, and then there are imports which are awaiting to come into India because sunset of thermal power plants is not only a case specific India, it's globally it is happening. So there's plenty and surplus of coal available overseas. So only thing which can come in between is government of India policies. As long as it is protective in nature and there are some dumping duty, anti-dumping duty being imposed on the imports, this protection can still play out. But largely, when huge surplus production comes into play, you have to also bring your prices down. So that is normal case out there. So with Coal India, it would be a recommendation to, I mean, take profits out there. Vedanta, Tata Steel, I mean, all steel companies are doing well, and domestic infra is likely to do well going forward. The only hurt is that because of iron ore prices going up, as you can see in the case of NMDC, so their input prices will go up, and they are not in a situation to take price hikes. So steel companies which are inward looking, again, it's a trading play. You can get 5-10% one day, but again, there would be a problem of profit taking coming to play. The only thing which looks to me a clear, where margin of safety is higher as far as business outlook is concerned, is maybe Hindalco or aluminum producer because they are recyclers of aluminum as well. And aluminum is used in multiple ventures. It's not only industrial, it's also for, food cans or cans, storage kind of a thing. So that space can look budging. So metals, one has to be selective. And there may be mining companies like NMDC or aluminum and copper producers like Hindalco are likely to do well. Steel manufacturers, so domestic looking steel manufacturers will do, it is more of a trading play rather than a structure or a trending buy. Realty is a very budging sector, and we have seen the kind of real estate sales which has happened. And this comes on a backdrop of when interest rate was on upward trajectory. So from 4% to 6.5, 5% is the repo rate being set by the RBI. And if you look at the home loan interest rate, it was 6.7, 6.8, which I last remember. From there, it is now up to 10.2, 10.5% kind of a home loan rate is there. Spite of that, 27, 28% kind of a real estate sales growth was seen in Q2 across the segments. That is the affordable segment, mid segment, and the premium segment. So everywhere, every company, be it Macrotech, Developer, Sova, DLF, Prestige, they all were reporting very, very strong set of numbers in Bombay, Godrej Properties, Overall Realty. So this again speaks about the kind of undercurrent or the economic strength India is sitting on and the rise in the per capita income of the people. At the same time, savings has gone up because when you book a property immediately with RERA coming into play and the norms coming into play, you don't pay 100% upfront, right? It's around 10-5% kind of a first installment goes, and then as a percentage of completion method, the money rolls out. So these bookings have primarily been done from the savings side because if you look at the banking advances growth portfolio, the real estate or home loans have not been that great. It has primarily in being from unsecured credit, that is the personal loan and credit card growth or the retail sales growth, which has driven this AUM growth. So people were sitting on good savings for the last 2-3 years, which they have started investing or maybe a first home buy in the real estate. So real estate is likely to do well going forward. Because if you look at the projects which are being on roll and the per annum revenue booking, it's more than 4x of the entire sector aggregate. So the projects in the pipeline, and those are sold out projects. The best part about all these companies is being whatever projects they have launched, there's 100% sold out. So there is No inventory built up happening out there. And at a time when, real estate sales was going up 27-28%, inventories came down by 3 or 4%. So that's a clear-cut case of a good robust demand happening out there. Input prices are still not gone up, demand is up, and tomorrow if interest rate cut cycle begins, this can see the second leg of good growth coming into play. So in a sweet spot, it will look expensive because stock prices have run up very high. But I think for the next 1 year, and if not 1 year, for next one quarter or say 5-6 months, this is likely to be the trend, and they would continue to be expensive. Now, since we have spoken about real estate, then what goes into making real estate is cement sector. Cement has been doing again because real estate has been doing well. Cement has been doing well. At the same time, infra spending by government on all the road projects and port projects has also been quite aggressive. What we have seen for last 2 years, cement volume has been quite steady and on a upward trajectory. So around say 9 to 10% kind of a volume growth was happening. This year itself, we are expecting double-digit kind of a volume growth towards the mid-teens, and next 2 years is also likely to be a double-digit volume growth from cement producing companies. So we have seen that in the case of say Dalmia Bharat or the Ultratech Cement, which have given out their numbers out. And since the input prices have been benign and controlled, their EBITDA per ton have started, coming up after that last year debacle which happened with most of the cement companies, primarily because of their input prices. That the power and fuel prices have gone up significantly. So it has cooled off and it's getting better and better day by day. So again, a cyclical play. It's valuation wise, most of the companies are expensive, but historically they have been so. So they were never comparable to their PE multiples or the growth with which they were growing, and the PE multiple justifiable. The other point which people have been arguing is they are almost talking about expanding their capacity on the industry level by 40 to 50% in next 2-3 years time frame. So with such kind of a capacity coming into play, how they would be able to maintain their profitability, because once you expand capacity, you have some interest cost being booked into it, some depreciation being played out there. So at PAT level, things may look bad, though volumes may still be there, revenue growth may still be there, operating profit onwards, because operating leverage may not be there. It can start to hurt these companies. But this is very undecided. I mean, the type of infra spending and growth we are seeing, and then Bharat Mara 2 project is about to be launched on the expansion of road. So earlier it was double laning of road, then it is 4 laning, now it can be 6 laning of road, then express highways, and all these things are in the pipeline. At the same time, I mean, there would be homes to be bought by many Indians, because still when the sizes of homes are likely to grow. So there are multiple arguments which can be put into place, like somebody who's living in a 2 BHK with a family of four may opt for a 4 BHK house, one room for each people out there with the increasing per capita income. So these arguments do look very, terrible, because we are that at that hockey stick inflection point as far as per capita GDP is concerned. So uh, one more good year on the economy side, and you will see that happening. So that is the reason why all these cement companies are planning a capacity expansion for the next 3-4 years. So only thing is, you may not make money in a hurry, but if you are an investor with a 2 to 3 year kind of a horizon, this is still a good sector to be into. I am now coming to the automobile sector. This is again a consumer durable kind of a sector. What we have seen is the numbers have been erratic. It has been all over the places for the last 6-7 months, but it's falling into place. So two-wheeler, Bajaj Auto, Hero MotoCorp, TVS, Eicher Motors. I mean, particularly Hero, Bajaj, and Eicher have already announced their new launches. And TVS Motor has started booking for their BMW bikes. So super bikes would be the norm for all these companies, along with the regular business which they have been doing. I think Q3 onwards things will look pretty good when it comes to the number of bikes sold on a year-on-year or a quarter-on-quarter basis. So high single digit to low double digit kind of a growth is where projection is for upcoming balance of the year, that is second half of FY24 and FY25. For on the four-wheeler side, Maruti has been doing exceptionally well, and the type of launches they have planned, and even they are, doubling the capacity for the next over a period of next 4 to 5 years. Electric vehicle launch has also been announced by Maruti. It's remains in a sweet spot, and slowly and gradually it has been again gaining up the momentum and the market share back. So the market is also expanding, but Maruti has been doing particularly good in that space. And this is the only listed play available out there. Last month numbers, what was worth was the commercial vehicles number. They have started showing some improvement, and particularly the numbers of Ashok Leyland, Tata Motors, and Mahindra was particularly good. Tractors have not been doing well, but this is not, again, you will argue that Scott's price is going up. I don't know why Scott's Kabuta price is going up, but as far as sales are concerned, and they were very dismal this month, and it's likely to be. So this year is likely to be a down year for tractor sales, but a good year for commercial vehicles, passenger vehicles, and two-wheeler sale. Here again, the topic can be, Hero MotoCorp, TVS, Eicher Motors from the two-wheeler space. Bajaj Auto, I would like to give it a skip because it has a too much of an international exposure. Around 40-45% of their revenue comes from African countries. So let's see how this Israel thing pans out. So there can be some problem out there. Other than that, the sector looks very good, and even Tata Motors now becomes interesting with this China stimulus coming into play, because bulk of the JLR sales happens in China. So that country is a primary driver of JLR sales. And not to forget, China has already started with the interest rate cut. So they are following a totally different monetary policy from the rest of the world. So that can come pretty much into play. So here it is a pick and choose sector, but overall it looks very pretty good and well settled. Power sector is in a zone of its own. It's no longer a utility sector. It's more of a growth sector, which is how things have been placed. So if you look at current installed capacity is 424 gigawatt, and by the end of 2030, the expectation it will reach to 817 gigawatts. So almost 400 gigawatt of additional capacity addition is likely to happen over the period of next 6 years. And see, what is happening is all this new capacity additions will largely come into the solar, wind, and renewable segment. And the PLF, the plant capacity utilization of these sectors is 35 to 40%. So if you install a 100 gigawatt kind of a capacity, the actual power output is only 35 gigawatt. And going by the pleasant run rate of power consumption of 10% and peak hours, actually it has shot up. The deficit was more than 10%. So this is exactly what the consumption pattern suggests, that this much of capacity expansion should be there to take care of, power demand. So you can look thermal, which is 238 now, will be 292 only. So around say 60 gigawatt of capacity addition only in thermal. Balance is where the maximum growth will come into play. And here we have done earlier JSW Energy, where the target price has already been achieved, though those projections were based on FY26 numbers. So right now we have a hold rating on that stock. But power as a basket, if you club JSW Energy, Tata Power, NTPC, Power Grid, it's a fair play, and this entire sector will keep budging for the next 2 to 3 years. Defense is in a zone of its own, with a lot of make in India thing happening. Government of India and acceptance of necessity kind of a thing has been rolled out, and they most of the major parts or components which were being produced outside India or in collaboration with someone is now being manufactured and produced in India. So defense budget has also been rocking around, let's see, gets around say 6 lakh crores of annual allocation for the defense budget, which is likely to go up by another 1.2 to 1.25 lakh crores per annum going forward as per the different projections of the government is there. But that will happen only after the government, the next government takes charge. So here, I mean, the execution is now operating leverage has rolled in. The execution is happening. Working capital cycle has come down. Payment from government is coming, and the technology transfer with their foreign counterparts has happened, and that's reflective in the numbers. So, like Bharat Electronics or Hindustan Aeronautics, data patterns, and all these companies are doing well. Only the concern is the valuation part. So valuation wise, I still think Hindustan Aeronautics remains the best bet out there, because if you are having ROE of 27, 28 with a growth rate in excess of 20-25%, at the same time it is available at a PE multiple of 19x 1 year forward. So this is not the case with say Bharat Electronics or Data Patterns or Keys and others in the segment. So one has to be choosy here in defense sector, but again a space to be in. Same is the case for railways. Railway stocks have moved up quite a lot, but trust me, it has not moved up to the full potential. If you look at the railway budget, last year the government of India, added additional 1 lakh crores to the railway budget. So it was used to be 1.4 lakh crores of allocation per annum, which went to 2.4 lakh crores. And the recent rollout discussion paper was there in the parliament where they said that this will another further top up of 1 lakh crore should be added to the railways to upgrade the laning system. I mean, railway tracks, four laning of tracks, bullet trains, upgrade of all the coaches, which is there, overall of the entire electronic system, new technology in place. Kavach is the safety technology which the government of India wants to roll out. So there will not be any train collision head on head. So all these things are very lucrative. Here also there are plenty of stocks out there. Many stock prices have moved up, but I do think that companies like RVNL or Incom still have a plenty of room to play out for in the railway side. So a sector to be in. Apart from that, I mean, we have come to the conclusion of this. Few sectors which we have not included in this the PPT are like pharma or chemicals. Pharma, to my mind, I think it has played out. Valuations are far expensive than what the growth we can expect. 10 to 12% kind of a growth is expected on the bottom line, whereas P multiples have gone to say 25-30%. Specialty chemical, the stock prices have corrected quite a lot, but the demand from Europe is still to come out. So China's stimulus may add immediately, and that is the reason why we have seen, prices of GNFC and all shooting up today. But that's more of a hope trade which is playing out there. China, from India, the specialty chemical business was not to the China. China was there, but it was not exactly China. It was more to the Europe. And Europe is still struggling with their own set of global growth. So these two sectors, I mean, at best can be avoided. Other than that, capital goods again expensive, but is likely to do well. So stocks like Vail, ABB, Siemens, and all will remain to be in a sweet spot. You won't have much price correction coming to play, but upside also will remain limited. But the trajectory is up. So with this, I think we have summed up the entire scenario. Just to give you two, three bullet point, US economy is good. Interest rate is round the corner. It's likely to, soften going forward. At the same time, geopolitical tension is there, but I don't think this will blow up in a larger way. India, everything is fine. Macroeconomic fundamentals are playing out well. It's just as be in the right sectors, right spot, things will play out. Q3 numbers will be much better than Q2 numbers. So real, I mean, the quarterly earnings growth is will be hitting the top for FY24 in Q3. So on backdrop of US stabilizing, Israel conflict not escalating further, and as we move into built up for the Q3 numbers post Q2, my own sense is we are going to hit 21,000 on Nifty by the time we end this year. So we are looking at buying on declines and on corrections if it comes through. The only caveat is if something, I mean, out of the way happens, that is a World War III scenario, then only one has to pause. Otherwise, it's a buy or dip kind of a strategy for Indian market. Sridhar, back to you. Please take charge.
Thanks, Dharmesh. Very informative. I think you covered almost all the sectors that we could speak of. The ending note was great. We look forward to the 21,000 levels sooner than later. I read somewhere you had mentioned that as Diwali now we moved it to December, so I hope there is nothing to see read in between the lines. Yeah.
Yeah, I
So
just booked up because of few unseen events happening in between. Otherwise, Diwali should have been 21. Who knows? It can still be. Diwali is on 14th of November, and we have 1 month more to go. 20 trading session is, I mean, 5% kind of a move you need on an index. So it's still achievable.
right. So while I'm talking to Dharmesh, in case you have any questions, please drop your questions on the chat box or the Q&A, and we'll take it up for you. Dharmesh, quickly, how worried should we be with this turmoil that's happening in Israel? From the looks of it, should they all get done in a week or so?
See, from the looks of it, I mean, I don't see any worry coming into play because we are already, today is the ninth day. It started on last week, Saturday morning. So we are on the eighth day, in fact. So till now, not much of a retaliation has happened. So intelligence says that this will get settled in 5 to 6 days time frame. And the good part about this is there is no retaliatory, I mean, major retaliatory course of action from the Hamas. So as long as it remains just like a blocking of the punch or one punch being thrown in between, it's fine. And the way things are cruising around, I think that's likely to be a scenario. They have allowed Israel to attack the and do the cleansing part and just to cool the tempers and to give some satisfaction that they have taken some revenge. This is being done on a tactical basis, and I think this is likely to die down soon.
Right. Hopefully. So on the IT space, like you very clearly mentioned, the Accenture numbers, the things don't seem to be very good in that space. However, from India and the adoption of AI might lead to something good in the tech space. You think this is something that people should look at from a 5 6 year horizon?
If you are looking at 5 6 year kind of a time horizon, definitely it's a good bet and benefit should be given to Indian IT companies because they have already demonstrated that earlier in the past about the capability and acumen in implementing the softwares which is there. So AI is a different ball game, but proactively most of these companies are setting up the teams and their expertise in place. They are training their people and they are getting overseas tie-ups in place so that at back home the employees are being trained to tackle the system. So I think they should be able to do that. It is a 6 to 9 months time still pending out there when actual flow starts trickling in on the order book side of the IT company. So deal wins is 6 to 9 months away. But the trajectory does look like that Indian companies will again garner the same kind of a share in the revenue, which they earlier used to do, while rolling it as a software as a service kind of a thing. So one should definitely acclimate it from a longer time perspective. But if you are just looking at a 1 year or 2 year kind of a time frame, and then it looks a bit challenging.
There's a question that's come on the chat box. Your views on paint companies?
See, paint companies are basically more of a cyclical kind of a business, and the worry or the negative part is that most of these stock prices have moved up, valuations are too high, and the capacity expansion which has been will happen out there is mind-boggling. Almost doubling of the capacity is going to happen in India on the all the paint companies out there. So volume-wise, I'm still, okay with that because the type of construction activity which has picked up and all these bookings which we were talking about real estate, eventually when these houses are constructed, they need to be painted. At the same time, refurbishment does happen, and you have the houses which are already there also needs to be painted. So that looks to be justified, but the competition will heat up. What competition does is takes away the pricing power. One. Second is crude oil volatility always keep all these paint companies in check. So as of now, the trade is that if in case crude oil prices go up to 100, $110. And Sridhar, one point to be noted out here is even before this Israel crisis happened, there was talks that crude oil prices will hit 110, $120 on the Brent side. So we were already anticipating such kind of a price movement in the crude oil because of the production cut by the GCC countries, and at the same time as winter seasons roll out because of heating, Europe and US does need heating oil.
Foreign
So
exchange.
from that perspective, paint companies should be avoided as of now because you have plenty of other good options available to buy. So why to hang on to paint companies?
Okay. What's your view on dollar rupee?
See, dollar rupee, one view is very clear. Rupee will outperform dollar. And that has been the case so far in this year gone by. Why I'm saying so? I'm saying so fundamentally. If you look at the reserves, I mean, foreign exchange reserves which India is sitting on, it's humongous. At the same time, the exports from India is going up because if you see the trade deficit, it has come to almost years multi-month low at $19 billion when they reported this September quarter number. So, and again, government of India has to be applauded for that because electronics has picked up in a big way. That manufacturing in India, made in India for the world, is now taking place. So even if dollar appreciates, I mean, it goes to 110, we will not see a depreciation in rupee happening. Optically, it will look 83, it will go to 84. But percentage wise, on a parity basis, rupee will not depreciate to the extent dollar is going to appreciate. So that is where the comfort is coming from. So as a parity trade, it will keep on playing, but in favor of India. So I don't see any major problem happening out there.
Right. There's one more question. It talks about monsoons being on the weaker note. What's the impact going forward?
As of now, it's a very minimal impact because even if the acreage in pulses has not been there, but there are sufficient reserves for that. Uh, Going and since the see it had the monsoon been very weak, where plantations and everything had not happened, then it would have a bigger impact. But the government has already taken care. If you see the gas subsidy rollout has been there, direct cash transfer is already happening, and in case marginal and low level farmers are getting impacted, I am very sure some announcements will come to take care of them. Maybe before Diwali or before Dashera, some freebies or goodies being given by the government of India to take care of poor segment of the or unprivileged segment of the society. So I don't think there's any meaningful impact of the slightly weak monsoon which was there.
Right. Do you expect any correction in the commodity markets?
See, commodity market has done nothing. I mean, year till date, if you look at aluminum, copper, zinc, rubber, tin, steel, they are actually down. It's negative on the international market. So they have not gone up. So why should they come down? And domestic demand has been good. The international prices don't seem like going anywhere as far as commodity is concerned. It's trading 1-2% up and down is what they are oscillating there. So no worries out there.
And that can be helpful to the infrastructure also.
Yes,
Infrastructure.
yes, definitely. Yeah, yeah, that is what we have been seeing in the numbers as well. For real estate, infra, all these companies are enjoying the low commodity prices.
So if you have any more questions, guys, please use the chat box or the Q&A. I'll be happy to take you for on your behalf to Dharmesh. All right, Dharmesh, there are no more questions. Thanks a lot for a very, very interesting speech on the markets and the updates that you gave. And thank you all for attending. It is our endeavor to keep doing this regularly so that you keep being informed from our end. And hopefully, it will help you make some decisions which you might have postponed or would have delayed. Thanks a lot.
Thank you so much.